Good morning and good afternoon, everybody, wherever you are. My name is Nathan Dean, and I'm a senior policy analyst with Bloomberg Intelligence in Washington, D.C., and I want to welcome you to BI's client call on the Inflation Reduction Act, which, if it passes, will arguably become one of President Biden's key accomplishments during his term so far. Joining me on today's call are my colleagues Brandon Barnes from Energy, Bob Barnett, Renewables, Duane Wright, Healthcare, Andrew Silverman, Tax, and Tish Walker, Patent Litigation. We're going to be talking about the respective sectors and the provisions in this bill and what you need to know for your portfolio. But first, I wanted to just give you some figures so you can understand how large the Inflation Reduction Act is compared to some of the other key stimulus or budget reconciliation bills that we've seen in the past. So just to give you a summary of where we are, these are the top line estimates that come from Senator Schumer and Senator Manchin. They are looking to raise $739 billion. $313 billion of that comes from the 15% corporate minimum tax. Andrew's going to be talking about all these tax provisions when we get to them. $288 billion from the prescription drug pricing reform, $124 billion from IRS tax enforcement, and $14 billion from the carried interest loophole. Those of you who are following this in the news cycle, obviously carried interest is very important in order to get Senator Sinema from Arizona's agreement on board. On the investment side, $433 billion, $369 billion of that comes in the energy security and climate change area, and then $64 billion in the Affordable Care Act extension. So the anticipation here is that the total deficit reduction would be just north of $300 billion. Now, how does this compare to stimulus packages that we've seen earlier before? Well, the CARES Act, if those going back to the COVID era, CARES Act was $2.7 trillion. The Paycheck Protection Program and Healthcare Enhancement Act was $733 billion. The Infrastructure Investment and Jobs Act, which passed last year, was $1.2 trillion. So this bill comes so much on the lower side when it comes about overall investment costs and so forth. This obviously has a tax proponent where the others didn't. However, it's important to note that this bill is passing through what is known as the reconciliation process. So for those of you who are not familiar with it, whenever you hear reconciliation process, it is a process that allows Democrats to avoid or bypass the legislative filibuster, and therefore you need to avoid 60 votes in the Senate, and you can pass it via a 50-50 tie, remembering the Democrats have control because the vice president is in the Democratic Party. So assuming that everything can get passed via what is known as the Byrd Act, essentially this rule essentially says that anything in this bill has to impact the budget. And as we speak, the Senate parliamentarian is reviewing the package to ensure that the provisions outlined can go via the reconciliation process. Now, the Senate parliamentarian ruling could come at any minute, and the voting on this could begin as soon as this weekend, first with the Senate and then second with the House. So before we get to odds of passage and so forth, let's talk about the bill. First, we're going to go to healthcare, then renewables, then energy, and finally tax. So Duane, I'm going to turn it over to you if you can give us just your key highlights of what you see is happening here. Thank you.
Thanks, Nathan. So I think it's worth talking about, as we think about the drug pricing reforms, how we got here. Democrats have been pushing for HHS to negotiate the price of prescription drugs ever since the Part D bill passed in 2003, if not before then, and that bill explicitly prevented the secretary from negotiating for lower prices. And Democrats have unveiled a number of bills since then to allow for the secretary to negotiate prices. And that all culminated with a vote during the previous Congress. And that version would have allowed the Secretary of HHS to negotiate upwards of 50 to maybe 250 therapeutic products as possible, and lower prices as close to launch at the early end of the lifespan of the product, and then use prices from overseas as a proxy for rate setting. Now, even though that bill passed the House with almost all of the Democrats, it was essentially a free vote. Some Democrats who felt that the provisions went too far supported it anyway because they knew that the Republicans in the Senate wouldn't allow the bill to move forward. A lot of these moderate Democrats in particular had pharmaceutical interests in their district, people who worked for pharmaceutical companies, and were really concerned about the impacts on innovation. So fast forward to 2021, that if the House passes a bill, there's a good chance it could become law. But the Democrats' majority was razor thin in the House, and it's at 50-50 in the Senate, as we all know, which provided significant leverage for those Democrats to scale back the drug pricing provisions to what we see now, which is essentially not going as high as 50 drugs or maybe 250 drugs, but limiting the negotiating process to those single source drugs that have been on the market, were FDA approved for 9 years, for those biologics that have been approved for 13 years, so long as there's no generic competition. And the bill lays out a cap, or sets a cap, not just on what's called the maximum fair price, which is essentially a minimum discount off of a list price, but the number of drugs that could be subject to negotiation each year. The prices would kick in 2026 with a limited number of drugs subject to negotiation or price caps, 10 in 2026, 15 in 2027 and 28, mostly on or all on Part D drugs. And then Part B drugs kick in 2028, leading to 20 drugs in 2029 and thereafter. So by 2029, we'll see essentially 60 drugs subject to the negotiating process and price caps. And we laid out a scenario in our note that was released earlier this week of those drugs that could be subject to price cuts. And we're looking at some price cuts of about 50 to 75% potentially, thinking about Ibrance from Pfizer, Jardiance from Lilly. The largest could be Januvia from Merck at about 75%. And some of these cuts are higher than others, largely because they've been on the market longer. And so the longer you've been on the market or FDA approved, the steeper the discount. And some of the impact on some of these companies is also going to be greater, and it's going to vary. And it largely depends on how big or how much of the Part D market that drug is part of. So it's possible now that we could see some of these companies have generic competition before 2026. So that could have an impact on whether these therapeutic products are subject to the negotiation process. But that depends on the timing of when these products come to market. And I'll just add that the drug pricing piece is the one area where Democrats, even Joe Manchin, have all supported. In fact, Senator Manchin has said he wanted to even go further than that. But of course, this has been reined back by a lot of the moderates in the party. So as we think about the healthcare piece, it's not just drug pricing. Of course, it's also the Affordable Care Act. And as folks will recall, the American Rescue Package from 2021 included some tax provisions that made premiums for the ACA, Affordable Care Act, more affordable for products that are sold on the marketplace. And this is a big deal for companies like Centene, which has roughly about 13% of the ACA marketplace, Elements and Molina, where they've really ramped up their presence in the ACA marketplace. The challenge here going into this reconciliation bill is that the ARPA tax credits, which were enhanced to make them the ACA plans more affordable, they expire at the end of this year. And by October, those individuals who are enrolled in an ACA plan may be benefiting from the lower premiums. They'll get notice that either it's business as usual for them in terms of next year, or if the tax credits go away, their premium prices could go up by as much as 50%. So Democrats were looking for a way out of this potential mess, especially since October is 1 month before the midterms. And when you think about the scale of who could be impacted, of the 14.5 million people enrolled in an ACA plan, roughly about 13 million benefit from these from the tax credits, but specifically the enhanced tax credits. And there are some estimates that roughly 3 million people could drop coverage. And for Centene, that could be a roughly $3 billion hit on the top line for next year, 2% of the revenue. But for a company like Oscar Health that staked their business model on the Affordable Care Act, we're talking about a 26% hit. So there's a lot in here that's not just about drug pricing. There's also provisions that relate to managed care and affordable health care coverage that managed care is also paying attention to. So with that, I'll stop and I'll turn it back to Nathan.
Great, thank you. And, Tish, we were talking earlier, and, there's some provisions in this bill as well that impacts your area. Can you give us just a brief summary of what you're seeing and what you're thinking?
Sure, thanks, Nathan. So yeah, I think, the impact you see on this in sort of the patent litigation, generic versus brand area is really regarding the list of drugs that's going to be selected and whether or not you're going to see a price impact potentially before a generic was expected by the market. But one thing I wanted to pick up on that Duane mentioned is, the first couple of years you're going to have a list of 10, then 15, and then 20. And each of those dates you have a selected drug publication date by which they're going to have to list the drugs that are going to be subject to the negotiation. So for 2026, the first date is September 1st, 2023. And so one thing, I think I wanted to note on our research was some of the drugs that you'll see potentially on that list could have generics that enter the market before 2026, but the issue is that as of September 1st, 2023, before, they don't have a generic yet on the market. So you may see in that initial list of 10 drugs that are expecting to have a generic, before that negotiated price would go into effect, but because that generic's not approved and on the market by the date they have to come up with the selected drug publication list, it still would be included in the list of negotiated drugs.
Great, thank you. So I'm going to turn it over to renewables for a second. Rob, your area, we'll start with you. When this bill came, we saw quite dramatic, I'd argue, price swings in some of the stocks that you're tracking. So can you just give us your views?
Sure thing, Nathan. Very happy to join this call. I think you are absolutely right in characterizing what unfolded in the clean tech space over the last week or so. Vestas, the world's largest wind turbine manufacturer, is up about 19% since Manchin announced his support for this bill. First Solar, the largest U.S.-based solar module maker, up 27%. SunPower, one of the larger U.S.-based project developers for solar, up 33%. So really big moves in some of the share prices. And I think that reflects optimism about how much more quickly demand for both wind and solar could grow should this bill get enacted into law. Now, already I would just flag that the industry is growing incredibly fast. If you look at the solar peer group that we track, the median growth rate for this year for sales is 50%. So find me any other industry that's growing anywhere close to that pace, right? This industry is already growing fast, and it's not just because of the U.S. I mean, these are global businesses, and you've got Repower EU, you've got the gas crisis over in Europe, you've got pretty strong policy support in China as well. So you've got all these factors that are just really pushing the pedal on how quickly the industry is growing. So is 50% going to get repeated again in 2023? Probably not, probably a bit more modest, but we do see that this kind of bill could sustain growth for the industry in this sort of double-digit level, maybe 20-25% kind of year over year. And this is just a very fast-moving train, I think. Wind industry is a bit interesting. The growth expectations there are a bit more tepid. So this could be a real catalyst to see your names like Vestas, Siemens Gamesa, Nordex, which are the European players, or GE in the U.S. These are the companies that could really see uptick in demand if these provisions go forward. The other thing that I think is quite interesting to think about on the bill is the idea of domestic manufacturing. If you're unfamiliar with the solar business, most of the global supply chain is oriented around China. Now, it's not true for the wind business. We've got kind of an oligopoly where if you look GE, Vestas, Siemens Gamesa, and Nordex, they really account for a big share of the Western projects and they make their turbines in the US, Europe, these sorts of places. But for the solar industry, China is really a key player, and I think that the bill wants to accelerate domestic manufacturing of some of these materials. And so First Solar, again, they're a company that we cover, and we think they're poised to really grow sales in the coming years as they bring new production facilities online to meet that rapidly growing demand. They've got a facility already being constructed in Ohio right now, and on their earnings call the other day, they talked about the idea that if this bill passes, they might consider additional new manufacturing facilities with a lead time of 24 months, right? So if you look out kind of 2024, 2025, maybe they're even bringing on new facilities. So let's see kind of what happens with the bill and whether they lay the groundwork for doing more. But I think there's a lot to watch on the manufacturing side. There's a company called REC Silicon, which makes polysilicon. It's key input for the solar industry. They've got a factory in Moses Lake, Washington that's been idled for a few years. They intend to bring it back online, and this could be the catalyst for them to do that. So a lot of exciting things, and that's, I think, why you got the share price optimism that's been boosted here in the last week or so. And yeah, that's the sort of high-level view on what's going on with wind and solar. I would just say there's also all kinds of interesting things related to hydrogen, batteries, carbon capture and storage, but maybe during Q&A we can go into some of that. And I'll turn it back over to you, Nathan.
Great.
Thank you.
Thank you. So let's go from clean energy to more traditional energy. Brandon, you put out a note last week. It was actually one of the highest read notes that we've had this month, summarizing 3 key takeaways. What are those three key takeaways?
Thanks, Nathan. I'm glad to see Team Energy is representing with Blazers today, showing everybody else up. That's probably why it got read so much, so they know how well we dress. So in all seriousness, I think there's so much in the bill, and so much of it's obviously tied to tax incentives, that I think it was important for us to try and parse out some of the sort of broader implications for traditional oil and gas companies. And I think it's easy to say there are 3 main things that we took away from this. First is that, offshore, this is a plus for offshore, in particular for future lease auctions, because, the Gulf of Mexico hasn't had a lease auction that's actually been valid since prior to November of 2021. And I'll get into that a little bit further. The second was E&Ps are probably going to take the biggest brunt of whatever costs are associated with this bill. It's, as I said in the note, it's not a carrot and stick approach. It's more like 2 sticks. You get 2 sticks. Sorry. One is methane fees, and the other one is higher royalty rates on federal lands, which I think is more impactful for onshore, just given the way that it's produced. The third thing is permitting. So one of our big themes over the last year, maybe even 2 years, if you're paying attention, has been that federal infrastructure permitting has been really difficult to get through for big projects, pipelines, transmission, LNG export, anything that requires federal permitting. The costs have been monumental. You're talking, between $100 and $200 million extra CapEx just for waiting on permitting when you didn't expect it. And so there's an element of that is maybe going to be agreed on later on as part of the horse trading that's going on. Manchin and Schumer have allegedly agreed to do this sometime in September. So I'll touch on that last. So just quickly, I think for offshore, the plus is there, 2 components to that. One is this would restore prior lease auctions offshore that have been invalidated by the courts. Particularly lease sale 257, which was in November of 21, Biggest bidders there, Chevron, Oxy, BP, Shell, Exxon, no surprise. Traditionally they are the biggest royalty payers to the U.S. government. That lease by itself was $192 million in bids. And so that got totally taken off the shelf by a court recently. There are a number of others that are being challenged in the courts. And so this bill would potentially put that back into place. And the reason we think that's material is because, as I've heard some of the industry say, every time you have 1 year of underinvestment, you have 5 years of lost production. Now, that may or may not be true, but I think what that means is that this is long-term investment in offshore, long-term investment in U.S. crude production. Gulf of Mexico, you sell acreage, the federal government sells acreage. That's how you get to explore and produce there. And the timeline there is quite long. It's a 5 to 10 year cycle from the time you get your auctioned off parcel of land from the government. So that past piece is critical. I think obviously more critical is the future piece, because we weren't supposed to have an offshore lease until at least fourth quarter 23 under the current planning by the Department of Interior. This bill would tie those offshore lease auctions to renewable leasing on fed lands as well. So you basically have to continue to hold these acreage auctions if you want to develop any renewables on federal lands, which has been in the planning stage for quite some time. So net positive, big positive for offshore, onshore as well, but offshore in particular, because Gulf of Mexico is only federal government leasing, really. Second point, I touched on E&Ps. So especially onshore E&Ps, there's a methane fee component that escalates over the next 3 years. And it's hard to know how that mechanically works, but certainly, methane has become a much bigger focus for the public and for regulators as they use new and different methods to identify methane clouds. A lot of news around, different groups flying over the Permian and identifying methane clouds and then targeting, however many facilities are within that area. Those have led to a lot of press. There's compliance issues, there's fines. So I think, that's a critical part that Manchin gave on in exchange for maybe permitting, maybe, acreage leasing, but it is a potential higher cost for E&Ps and to a lesser extent to the midstream. The second stick that I identify would be higher royalties. So they'll raise the royalty rates for onshore and offshore. Now, that's not as bad because obviously if you suddenly have more acreage that you can lease, you can pay those royalties and absorb that. But if you are getting bad acreage, which has been the allegation, any of those increased costs aren't helpful to the exploration and production companies, hits that bottom line. Final point that I want to touch on for this portion is the permitting, this promise of future permitting. I think we don't really know whether that's going to materialize, but it would be sometime in the fall. It's essentially a win-win for renewables and traditional fossils because it would speed up the permitting program, which has been such a problem for everybody. And it applies equally across the board to, solar and transmission lines and pipelines. So whatever they do there is a net positive. Interestingly, I'll just say that Mountain Valley Pipeline, which is a home state pipe for Senator Manchin, has been specifically mentioned and specifically targeted in anything that happens in the future. We're very curious to watch that. That's the last remaining major greenfield natural gas project in the U.S. that is crossing state lines. So I'll leave it there and turn it back to you, Nathan.
Great, thank you. So far we've been talking about sectors, healthcare, energy, renewables. Andrew, let's talk to you with tax. Let's go multi-sector. A lot of folks are interested in this 15% corporate minimum tax, also carried interest. Can you just give us some of your views of what are the key provisions, what are the impacts, and what are some of the industries that we have to be most, I don't want to say concerned, but most of the industries that we should be looking for?
Yeah, thanks, Nathan. So there are a handful of revenue raisers and a spate of tax perks in the bill. As you mentioned, the 15% minimum tax is the main revenue driver of this bill. I'll get into it in a moment, but suffice it to say it raises $315 billion out of the $470 billion that the bill would raise in tax revenue. And then the second biggest revenue raiser is IRS funding. So Manchin and Schumer took the position that spending $80 billion on the IRS, with more than half of that going to enforcement, will raise $204 billion over a decade. And then lastly, the major piece is, well, the major two pieces are the carried interest loophole that they're trying to fix and the Superfund petroleum tax. So starting with 15% minimum tax, I describe it really as the opposite of a corporate statutory tax increase. It raises companies' effective tax rates, but it does so by barring companies from taking their full tax deductions rather than by raising the corporate tax rate itself. That stays at 21%. But significantly, the minimum tax doesn't cap all deductions. So net operating losses, for example, are largely carved out. So even if the minimum tax is adopted, many companies wouldn't actually reach a 15% effective tax rate. And vice versa, this tax could cause some companies' tax rates to rise far above 15% or 21% for that matter. It's sort of like a tornado where it hits one house on one side of the road and then skips over and hits another house on the other side of the road and then skips to another street. You know, different companies in the same industry could be affected completely differently for minimum tax purposes. If companies don't particularly seem worried about the 50% minimum tax, I'd point to three possible reasons why. The first is that it's a successor to the corporate alternative minimum tax, but not nearly as all-encompassing as the original AMT. And the original AMT didn't exactly set the world on fire, so companies were still able to get tax rates far below 15%. Secondly, there are just so many carve-outs from this minimum tax. I mentioned net operating losses. You can also take foreign tax credits. You can take general business credits like the green tax credits in the Inflation Reduction Act. It'd be counterintuitive if you introduced this tax and then said, well, all of those other credits in the bill you can't take now because of this minimum tax. The new markets tax credit is included, the orphan drug tax credit, the R&D tax credit, all of those things are permissible under this 15% minimum tax. I'd also point out that using accounting rules to calculate tax doesn't ensure that all loopholes are excluded. US GAAP isn't as riddled with loopholes as the US tax code, but it's not entirely free from them either. And in order for income to be taxable under this minimum tax, it actually has to be income. So a company can take a whole lot of above-the-line deductions before it even arrives at a pre-tax income amount, as demonstrated by marijuana companies, for example, that are prohibited from taking ordinary and necessary business deductions due to Section 280E. And as I mentioned, the IRA would increase the IRS budget by $80 billion over 10 years. Manchin and Schumer estimate that $1 of additional IRS funding produces about $2.50 of additional revenue. The IRS itself actually says that they think $1 of additional funding produces $6 of additional revenue. So we know that, well, we think that more cash for the IRS will probably result in greater tax revenue, but is it going to be $205 billion? Is it going to be $500 billion? Is it going to be $1 billion? It's hard to say, but most people think that what Schumer and Manchin have estimated is relatively conservative. And on carried interest, if you're not familiar with the concept, what we're talking about here is private equity fund managers using U.S. partnership tax rules to get a capital gains tax rate paid to them via, you know, a carried interest interest as opposed to sort of an employment arrangement. So it's like what you would get payment for services for a corporation, but instead of getting taxed as salary, you get taxed as capital gains instead. And Democrats have talked about closing the carried interest loophole for years. This provision doesn't really close it, but it sort of closes it, and it does that by lengthening the amount of time that a fund would have to hold an investment for a fund manager to get their capital gains from 3 years, which is currently to 5 years. And lastly, as I mentioned, the bill resuscitates a 16.5-cent per barrel tax on oil refiners that hadn't been in place since 1995. It's known as a Superfund tax because it goes to pay for environmental cleanup, and it joins another tax under that same provision that had already been in effect. So now the combined total for oil and gas companies would be about 26 cents per barrel, and mainly this new tax applies to oil refiners. So those are the revenue raisers. I said there are a spate of tax credits. There are a ton of tax credits in this bill, solar and wind energy tax credits, the production and investment tax credits are extended for 10 years. The EV tax credit is also extended, but now has new restrictions placed on it. So people that make too much money, over $300,000 for a married couple filing jointly, can no longer get the EV credit. And there's also a cap on how expensive a car has to be, or inexpensive a car has to be in order for it to qualify for the credit. So there's a cap of $55,000 on it. And importantly, to get the full $7,500 credit, a car has to satisfy two requirements. Has to be assembled in North America, which is Canada, the United States, and Mexico, but also its battery has to contain critical minerals, mainly derived from North America and its trading partners. And you could read that as not derived from China. And it's 40% now, but it ramps up every year until it reaches 80%. And car companies are really upset about this because they actually don't have the ability right now to source those materials entirely, or at least even 80% from North America. There's also a 10-year carbon sequestration credit. That's a tax credit to incentivize companies to pay for new technology to help them reduce carbon emissions. There's a nuclear production tax credit. There's a biodiesel tax credit, a hydrogen production tax credit. There are a number of tax credits for homeowners to incorporate clean energy technology. In total, it's $385 billion worth of green energy tax credits. And then the bill also reduces the deficit by $305 billion. And the importance of that, in my mind, is that it's sort of a cushion, right? We're using reconciliation here, and you have to make everything ostensibly budget neutral. So by putting that provision in there and saying, oh, we're also going to reduce the deficit, it gives you this $300 billion cushion that if the tax provisions you put in there don't raise as much money as you want, well, it reduces the deficit a little bit less, so what? But importantly, what doesn't the bill do? It leaves out a few green energy tax provisions that had been introduced in past tax bills or in the Build Back Better bill, like the waste energy recovery property credit had been passed in 2020, wasn't in this bill. Also, the clean energy publicly traded partnership allowance was in Build Back Better, not in this bill. And of course, there's the long list of tax credits that Republicans favor, not surprisingly, not included by the Democrats here, like racehorse depreciation, mine safety tax credits, tax allowance for timber companies. Those have not appeared in this bill, but I don't think that they're gone forever. I think what they end up doing is appearing in a year-end tax bill, and I think there's a good chance that those, in fact, get passed by a bipartisan majority. Of course, it all depends on what happens in midterm elections. But you know, if we end up where I think we might end up with the House going to the Democrats, or the House going to the Republicans, and the Senate sort of staying with the Democrats, or even if the Democrats gain seats, then you have a situation, I think, where the parties sort of need to come together in the lame duck session to get something done, because their situation could possibly be worse next year. And you're not going to get anything done the year after midterm elections, so you might have to wait 2 years for some of these expired provisions to come back again. So in essence, I think the Democrats have a situation in which they can have their cake and eat it too. They can adopt most of these green tax provisions that they want, and the Democrats only vote, and then more broadly, they can get some of these other provisions in using this bipartisan vote at the end of the year. So not bad for Democrats if they can get it done. That's it for me, Nathan.
Great. So I'm going to start asking you a few questions, and Duane, I'm going to come to you first, just with this simple question: is this going to pass?
Nathan, great question. I get that question a lot. I have been under the operating belief since Manchin essentially said no to Build Back Better in November, December, that Democrats would be able to pass a Build Back Better Light, or now Inflation Reduction Act. There's just enough in there to get all of the Democrats on board. I think there's probably enough cushion, as Andrew mentioned, to get Senator Sinema on board with some of the tax pieces. So at the end of the day, we put odds at 70% that this would pass. We didn't put which week it would pass, but we did say it would pass. So I think it will have the votes. I think they'll find a way to get Sinema on board. Obviously, the feedback from the parliamentarian in terms of what can stay in, what can't be in matters. But at the end of the day, there's a path forward for these proposals to pass in the next couple of weeks.
Great. And so, Andrew, we tend to have a lot of individuals from New Jersey and New York who attend our calls. Is there a chance that the SALT deduction is going to be included in here, or is it just going to be one of those where we see some political headlines and then nothing gets done?
Yeah, political headlines and then nothing gets done. Manchin has specifically said that he doesn't want to lift the ceiling on the state and local tax deduction, and that it was a deal breaker for him. So it's out of this bill, and it seems like the moderates in the House have sort of rolled over on that, even though they said it was a deal breaker for them. As soon as he said it wasn't going to be part of this deal, they were sort of like, okay. So we'll have to wait and see what happens, but certainly not in this bill.
So just another question on tax, though. So, like, if you see the Republican talking points, they've been pushing hard this idea that the Inflation Reduction Act raises taxes for individuals. Is that correct? Does this bill raise taxes for individuals?
Well, so what the bill is supposed to do is not raise taxes for anybody who makes less than $400,000 per year. And I think what I think is really stretching the truth to say that it doesn't do that. I mean, just because you apply tax to a company, it doesn't mean that you're not going to be essentially taxing that company's customers because they can pass it through to their customers. They can raise prices. That's why so many of the carbon tax proposals, for example, have a dividend component. It's assumed that oil companies will take those extra prices and pass it through to consumers, and then there's this dividend aspect to the carbon tax that they know the people are paying more, and so they get part of the money that they're paying in these taxes back again to sort of compensate for the tax that's been passed through. And I think nobody would reasonably argue that a VAT doesn't apply to individuals just because it's applied to businesses and then passed on through to them. So I think the simple answer to your question is this raises taxes for individuals.
Fair enough. So, Rob, I'm going to come back to you on renewables. There's a lot in this bill that provides, I would argue, a boost for the renewables sector. Do wind and solar technologies still need these subsidies, or are they strong enough to stand on their own? So if you do apply these, boosts, if you call it, is this something that's just going to, put it into almost a hyperdrive, if I can use that terminology?
Yeah, it's a great question. And I think that, at the end of the day, I am of the belief that the renewable wind and solar industries, at least onshore wind, are mature technologies. They've been around for quite a few decades at this point. The solar electrons that you can install today without subsidy are essentially the cheapest electron that you can put on the grid. Right next to it is wind. Now, this is based on what's generally called levelized cost of electricity analysis. It tries to make an apples to apples comparison for wind, solar, and other technologies. Now, of course, wind and solar are intermittent. So if you wanted to, you could ultimately pair them up with batteries. So solar plus battery, or wind plus battery, or solar plus maybe even some kind of hydrogen option, right? These are the kinds of considerations that I think might be coming about because of the bill, and maybe even make the technologies a bit more robust. But I think that it's hard to argue that the economics don't work already. So I think that it's right that this kind of bill really just accelerate something that would probably move pretty quickly, even if the bill weren't there. Now, I know the trade associations aren't allowed to say that, right? They got to say that this is essential. But I think I think that that's probably a bit unnecessary. At the same time, you'd be crazy not to take it, right? If the tax credits are there, you're going to use them to your advantage, and so. I think it gives some uplift, but I think the industry will grow pretty quickly, even without such subsidies.
Sounds good. And Brandon, just on the traditional energy side, can you give us a little bit more information about what's happening with the Mountain Valley Pipeline that you mentioned? And secondly, what is this about legislation that Senator Manchin and Schumer are going to agree to pass later in September about permitting?
Yeah, I'll start with the second one first, which means the first one's going second, because it dovetails with what Rob just said. So I think one of the things that has hurt wind and solar on the bigger project side, and frankly, most big infrastructure projects in the last 5 years, has been a real pushback on transmission lines, pushback on and laying anything underground or across the ground that goes through private lands, right? Because the U.S. has a very interesting ownership system when it comes to who owns the ground and the mineral rights. But federal government has the ability, if it's in a certain level of public interest, to take parts of that land to put pipelines, to put highways through, to put transmission lines through. So most of the work has been done on this permitting side, and many big projects, I think Windcatcher was the last one I remember, where they've just been stopped completely by real opposition on the ground in terms of permitting. And I know it sounds like a really boring topic, but it's been material for a bunch of different projects, particularly midstream. And so there's a wish list that Manchin has put out that we've seen, reported around by different people in the news sphere. I think the key takeaways there is what they're looking at is capping environmental review to a certain number of years, 2 years for the bigger projects, and then also capping how much time they can go back through a re-review if a court finds that there's some issue. Those are critical for certainty. Those don't probably change permitting timeframes, which have been creeping up over the years. They've almost doubled, at least for midstream, in the last 5 years. But a good backstop for them, reinstating some changes from the Trump administration, interestingly enough, on Clean Water Act permitting. I think most importantly for hydrogen is giving FERC clear jurisdiction over permitting hydrogen infrastructure, which is a real gray area. Manchin's committee in the Senate has held a bunch of hearings on that. Where it gets interesting is that in one of the more recent drafts that have been sort of talking points that have been leaked on the permitting agreement that allegedly will happen in the fall before September 30th is that Mountain Valley Pipeline, which is Equitrans Midstream's project, it's like a 2 BCF per day natural gas pipe, taking gas from Utica Marcellus and running it down to the Southeast market. That has been specifically identified as requiring to be pushed through various means. They're in permitting now. We don't think that anything changes, even if this bill gets passed as is, as we've seen on the wish list, which is probably pretty unlikely. We don't think it changes the timing for the project. What it would do is it would switch the courts that you're allowed to sue them under. They've had a lot of trouble in the current court system they've been in. There's a lot of questions swirling around about that, but I think it's fascinating to see that this project in particular is one of the reasons maybe that Manchin has agreed to go forward with the reconciliation bill. We don't typically see specific infrastructure projects identified in legislation as moving forward. I think the last time we saw this was Tennessee Valley authorities, some of their stuff on like dams and hydroelectric. Look, this, to pull back a little bit, the permitting stuff, that could get bipartisan support. It's win-win for both sides of the table. The problem is there's probably going to be a lot of concern on each side that it's favoring, renewables over oil and gas, or it's favoring oil and gas over renewables. And so that fight is going to happen. And what ultimately comes out of this bill, which would be standalone and need 60 votes, who knows what that looks like in the end. And certainly it's going to be at a rough time for politicians to focus when it's, right up on the midterm elections. So we'll see. We'll see what happens there.
Great. So
can I weigh in on this?
Brandon,
I'm really struck by your comments, and I think that I would reiterate that the permitting piece that you highlighted is a pretty good consideration for thinking about the wind and solar business. I mean, in Europe, there's been a lot of discussion around permitting and NIMBYism as well with this Repower EU proposal that they've got. And I think when you think about a solar project, the pace at which you can do solar is pretty incredible. If you didn't have to deal with all the permitting issues, you can do a solar project in 6 months, 9 months. I mean, it is a fast timeline. You can build solar power more quickly than almost any other energy infrastructure, but the permitting piece is what ties it up. Wind project, you can do a wind project in kind of 12-month type timeline. Now, again, nobody's doing them that quick because most of the process is actually on the permitting side. So I think anything that can be done to streamline the permitting is going to be beneficial for the industry. So it's good. Let's at least for anyone who's cheering for the renewable side of the equation, that would be a welcome development.
Great. So I want to finish our discussion on healthcare because that's what gets a lot of the news headlines as well. And Duane, when I read the news, a lot of the focus on drug pricing is the impact on the bigger brand names. But what are the impacts on the generics and the biosimilars?
Yeah, thanks, Nathan. It's a great question because a lot of the focus is on the brand name manufacturers. Tish alluded to this earlier, which is that the bill sets up a process, essentially a timeline for all of these negotiations to take place. And there's a scenario where even though under current law, there's an expectation that generics will enter the market and theoretically help drive down prices. The way this bill is set up, generics could be coming into a marketplace where a drug has been subject to negotiation, has had their price cut by 50% or even higher. And so there's an uncertain price point or entry point for these generics and biosimilar makers to jump in. And it's not like these decisions for these companies are made a year or two before they get into the market. These decisions are made years in advance. For the average biosimilar, it can take 8 to 10 years. It can take quite a bit of time for generic manufacturers to jump in. And so these companies are now faced with a scenario that they had expected to enter into the market in 2025, 2026, 2027 at a certain price point. Now that price point where they thought they could enter has been altered because the new rates that have been set are essentially lower than that. So there's a decision now, at least for the first couple of years, where these generic manufacturers are going to have to decide whether it's worth going forward. And then they're just going to have to think about after the first couple of years where they want to jump in the marketplace. And the key here is that there's just a lot of uncertainty as to which drugs are going to be selected for negotiation and then what that ultimate price point is going to be. So a lot of uncertainty for these generic manufacturers, the biosimilar manufacturers on how to enter the marketplace under this new bill.
Yeah, and just to piggyback on that, particularly, if you think about it from the business perspective of a generic company, usually they're looking at the patent expirations, right, as the date on when they are ramping up their timeline for when they're going to enter the market, either with a generic or a biosimilar. And as Duane said, this takes a lot of time. There's a lot of investment, especially with a biosimilar. And so now you have a situation where you still have that determination you have to make around the patents, but now you're potentially facing a scenario where maybe the patents aren't expiring until a later date, but, Medicare is going to be negotiating the price and cutting that down, and that leaves a little bit of uncertainty for what their, return on investment is going to be for bringing a generic or a biosimilar into the market, right? And so, you hope that doesn't stifle the competition on their end, because the ultimate goal of bringing generics and biosimilars to the market is so that you get some competition and you get some, price competition. So it'll be interesting to see, how this plays out.
Great. Thank you, Tish. Thank you, Duane. I want to thank you all for joining our call today. If you do have any further questions or you would like to speak with us individually, please reach out. Again, my name is Nathan Dean. It's ndean10 at bloomberg.net. Be happy to push you into any of our analysts, but you can also find us on Twitter, LinkedIn. We're here to help. So with that, I'm going to let you all get back to your day. Wish you a very happy day and speak to you soon. Thank you.